Hey guys, welcome back to Andrew Invests. Last week was a huge week for earnings with various tech companies reporting, including many that I own. But the one stock that I decided to buy more shares in was Visa. Now, it was also a very volatile week for the stock market, with the S&P 500 now having dropped 10% since its previous peak and officially entering correction territory. But this is mostly due to macro factors like the Israel-Palestine conflict and not the earnings themselves, in my opinion, which were stellar at best and average at worst. So this represents a great opportunity for investors to pick up shares on the cheap in companies that they like. But what was it specifically about Visa stock that made me buy more shares in them? Today, let's go through their earnings and why I think the stock is undervalued.
Looks like a double beat, right? Top and bottom?
That's right. A pretty strong quarter for the fiscal fourth quarter here for Visa. Beat on the top and bottom line, though. Scott, you mentioned those comments from Visa CEO Al Kelly sounding pretty upbeat on the consumer. He says here, quote, "We saw a continuation of many of the spending trends present throughout 2022. He says strength in consumer payments, resilience in e-commerce, and an ongoing recovery in cross-border travel. Also talks about the strong results here. He says despite the broader macro uncertainty and geopolitical turmoil, Visa did have a strong quarter. Says as we look ahead, we do see some short-term uncertainty, but remains confident in the long-term growth trajectory."
So Visa pretty much destroyed its earnings expectations, with revenue growing by 11% year on year and earnings per share by 22% year on year. Now, that's a really high growth rate for a company that many people think has matured and has left its growth phase. Despite the earnings beat, Visa stock sold off anyway. And why was that? Well, in the earnings call with the CEO, he did mention that there may be some slight consumer weakness in 2024, and thus the growth rate next year may not be as high as this year. However, he did reiterate that long-term, Visa can still expect a low double-digit growth rate.
Is the structural growth of this company sustainably at the same 10 to 12% rate it's been, or has anything changed?
First, the underlying drivers, as we shared, both payments volume and processed transactions will be growing in the low double digits, which is very consistent and reflects the stable business trends that we see in the underlying drivers.
However, when Mastercard reported earnings, they were a bit more forceful about their negative economic projections for consumer spending, and that caused their stock to drop by nearly 5%. And Visa traded down in conjunction. Personally, I'm not too worried about short-term economic factors, and I'm investing for the long term. So I used the opportunity to buy some more Visa stock at around my average buy-in price. One of the key factors that has driven revenue growth for both Visa and Mastercard over the last few years has been cross-border payments volume. Now, both companies are allowed to charge a higher percentage fees for cross-border payments as opposed to same-country payments. So they're really important for revenue growth for both companies. This quarter, Visa's revenue for cross-border payments increased by 16%, whereas Mastercard increased it by 21%. That's a significantly higher growth rate, and it is one that Visa needs to improve. Most of this, in my opinion, is due to Visa Europe being significantly behind Mastercard, and that's why they've split their revenue into both excluding Europe and including Europe. However, this is an area which Visa can potentially catch up on for Mastercard in the future. Another metric to pay attention to when evaluating Visa and Mastercard is client incentives. This is a category that represents most of these companies' expenses, and it effectively is a payment to banks or fintechs that forces them to remain the only partner of these companies. Pretty much every bank will be the sole recipient of either Mastercard or Visa cards, and these payments effectively keep them so. It's very similar to the payment that Google makes each year to Apple to cause Google search engine to be the default on Safari. Now, the Justice Department does look at these pretty negatively, but they have been fine so far. However, the increase in the payments made was around 20% for Visa and 22% for Mastercard. So Visa is a little bit better off, but the increase in these over the years does represent increased competition between the two companies, as well as potential disruptors elsewhere. Other than client incentives, Visa has very few expenditures and is highly capital light. It only spends around 3% of its total revenue on capital expenditure. And that's a really crazy number because CapEx is the money invested in order to increase the revenue each year, and it's only 3%. In addition to that, when you look at the free cash flow of the company, almost all of the revenue is going directly into free cash flow for the investors. What's not to like about that? That means that the company nearly has a 5% free cash flow yield, which is really high for a company with still very high growth rates. One of the potential downsides of Visa as a business model is that it can't really reinvest money into itself in order to drive further revenue growth. And that's because you can't really pay people to spend more money on a Visa card. You might be able to increase the fee paid, but you can't force people to spend more money. But I wouldn't necessarily see this as a downside because it means that almost all capital can be returned to shareholders directly. And that has been reflected this quarter with Visa announcing a 16% on its dividend year on year and also announcing a 25 billion share buyback program. If we look at Visa historically, we can see that it's increased its dividend year on year since 2008, while still maintaining a below 25% dividend payout ratio, which is very healthy in my opinion. We can also see that the company has bought back over 2% of its shares year on year. That means you're getting paid more dividends each year and also having a larger slice of the business because there's less available shares on the market. One of the biggest recent risks to Visa and Mastercard's duopoly has been the Credit Card Competition Act of 2023. That's a proposed bill whereby banks would be forced to provide a secondary network in which retailers can route their payments rather than using the Visa network, and mean that Visa would be cut out of the payment process entirely unless it massively lowered its fees. That's obviously a large risk, but it would be very beneficial to retailers for whom transaction fees makes up a large portion of their revenues. But it would be a very big negative for banks who would lose their cut of the fees and also for consumers who would lose credit card points. I personally don't think it's going to go through because consumers have been very active in lobbying politicians, but there is always a risk. I think it's interesting that whilst the bill was in progress around a month and a half ago, there were reports that Visa and Mastercard planned to increase their transaction fees in the US. Now, personally, I don't think that there was any truth in this, and it was probably just a made-up story by retailers to support them. But why would they do this whilst the legislation was in progress? It would only prove to others that they are a duopoly and need to be regulated. Mastercard quickly denied it 5 days later, but I do think this actually shows the pricing power of these two companies. If they were to increase their fees, there's pretty much nothing that anyone could do about it. No retailers would stop accepting Visa or Mastercard after all. Let's do a discounted cash flow analysis, or DCF, on Visa. Now, if you don't know what that is, it's effectively a way of valuing a company's future cash flows based on its current day valuation and plugging in some estimates for what you think the revenue will be, growth rate will be in the future, the EBITDA margin or the earnings profit margin, and the CapEx margin. You also discount all the cash flows by a rate at which you could get for putting your money into something in the present day, whether it's cash or the S&P 500. So going through these fields, I'll explain my thought process behind putting those numbers. I've put 8% for the discount rate because I've seen projections for the S&P 500 where it could be very low in the future decade, and I think 10% is probably a bit of an overestimate for the S&P 500. But I think an 8% discount rate is good for the long term. I've put an 11% for a projected revenue growth rate because the Visa CEO himself has said that that is a realistic expectation for revenue growth in the future. And in addition to that, 75% of the world's payments are still made in cash. So I still think that there's a lot of room for growth in that number. I've put a figure of 68% for the EBITDA margin, as historically that's a very standard number, even though it's been around 65% this year specifically. The capex margin I put at 3%, which is historically what it's always been. And plugging all of those numbers into the future, you can see that the price of fair value based on those assumptions and the cash flows is around 257 per share, which is 12% above the current price today. So that's why I'm buying in. I don't think it's massively undervalued, but I think a company of the quality of Visa is worth buying when it is 12% undervalued, in my opinion. Overall, I think Visa is a fantastic capital-light company that still has a giant runway for growth, and that's why I've been investing my own money into the company. If you guys agree or disagree with me on Visa, I'd be very curious to know in the comments, or if you had any other thoughts about the earnings this week, I'd also be curious to hear those. So let me know what you guys think, and I'll see you guys next time.